I'm going to get straight to the point. There are good losses and there are bad losses. The problem is most traders don't know how to identify the difference. In this video, I'm going to be very raw, uncut. I'm going to show you in US 30 how you could identify the difference between a good loss and a bad loss. A lot of the times, that is stopping you from being consistently profitable. You're probably too zoomed in and you don't really know how to identify it. So I'm going to show you in US 30 how I would explain that in the same value area where it could be so easy for you to get confused. I want to share with you a very brief story as well. As a trader that I worked with way over 6 months ago, was trading a system that had some overlaps as to how we trade, not exactly the same, still looking for similar areas in terms of volume, liquidity, etc. But we was able to get rid of all of the garbage positions, and that was all we needed to do. There was just too many unnecessary losses. But if you don't know what to look out for, you'll just keep hammering trades and think that you're doing most of the right things. And you might think, well, I need to do something completely different to be profitable. It's not about that. It's about how do you know how to stay out of the market? How do you avoid those losses that are not part of your statistical edge? Well, let's take a look at it. So we're going to dive straight into the US 30. So let's keep it really simple. Value area. You can clearly see at the high here, this is where most of the volume is. And I want to firstly explain to you the differences between this piece of price action and this piece of price action. Bar the obvious, right? You can see the big scoop and the gap. But what I want to first show you is if I take this piece of price like that and we match it to here, is it the same? At first glance, you might say no. If I shrink this and then we zoom in, you will see it's the same type of price action that matches up. Same type of behavior. And the reason why this is important is because when you're too zoomed in, and this is where all of the losses came, when you're too zoomed in, you will think that this is the same as this. The only thing this has in common, it's in the value areas where most of the volume, the bigger players are going to step in, where this has more of a tendency to be complex, develop, take a lot more losses versus this. So what we're going to do is we're going to dive into this piece of price action and that you will see. So where is the main problem? The main problem is too low of time frames. Now it's statistically proven that people that scalp, people that trade into the lower time frames have a smaller chance to succeed. This is the data, not my opinion. So I need you to approach it with an open mind, is that your lack of understanding with all of the time frames is the problem. It's not about just the lower time frame. It's about you camping out on the lower time frame, having no real regard to the bigger picture. So use them all together. Don't just rely on the lower time frame. Rely on everything and build a trade idea. So if I was to look at that piece of price here that I showed you, I would think it's exactly the same as that bigger piece of price action to the left, but the reality is very different. So now what we need to do is go back to that piece of price, and I put the high on in relation to where we are. As you can see there, we've got this high. This was the one that broke and we sold off. Now when I go to the 4 hour time frame, you'll see in relation to this piece of price, notice how on the 4 hour we wick towards that high. So we've got that bullish wick. If I then go to the 1 hour time frame, and then let's say I'm looking for entries, I'm looking to sell US 30 because I know this is where the bigger amounts of volume is going to kick in. I would naturally start looking for sell positions around here. Now, if you go into the super low time frames, I'm sure there's an entry in here in multiple different strategies, but more so I want to show you this one. So this would be an example of what I would call an avoidable loss, an unnecessary loss. Notice how all of the consolidation to the left is within all of this piece of price action. So when you're taking trades in here, it's more likely to be part of this, part of all of the consolidation. So you could take loss after loss after loss just because you're in the same value area without waiting for the market to do what it always does before it goes on for its bigger runs. It's going to convincingly break a significant low or a significant high, meaning something like this, not something that just taps it or wicks to it. I'm not interested in the cherry-picked examples and when it wicks to it and still goes. I'm talking about the consistency here. So when we go into the lower time frame and you blow this chart up, you can convince yourself and start to put an overimportance or overvalue the wrong things. So you could start overvaluing the isolated entry. What's the problem with that? You're not taking into consideration the positioning. You're not taking into consideration the sequence of the move, the value area, whether it's wicked to it, whether it's broken above the high, because all you're doing, and I'm on the 15 at this point, you could be even going lower. You could be going, right, this is what I'm interested in. I'm looking for price to move above here. This is what happened with someone who traded I kind of want to call it a liquidity based system, put it that way, right? So essentially it would be an example of, we put this high in here and we can see price has not taken out that high, right? Eventually we want to see that go above and then look for sells. So limit order here, bang, loss. I would call that a bullshit loss. There's no reason why you should be taking that trade. Too much high risk in it for multiple other reasons, but in the sense of, if I was like this and I had my chart like that, yeah, 100%, I would be in line with that. I would look at it as, well, there's the high, there's the gap, we want that to be filled, and then we can start to either look for our entries around here, or we can set a limit, in, out, loss. And you would say, well, it's just part of the game, it's part of the sequence. To a degree, it's not completely invalid, but these are avoidable losses when you understand how to piece all of this piece of price action together. There are much better ways, and I'm going to go to the sequence in a second. So notice how we build up a bit of volume, we then go back up and we finally break above the high, and then we wash everything out before we actually start to fully step in. I'm not even going to go into detail. Well, actually, I'll go into subtle detail. If you look as a bit of a clue, that 1 hour price action, all of the wicks here, that was already the clue that we was going to come back up to test the high. Versus, notice when we break the high here, what's the difference do you see within this section? What do you see? Follow through, follow through. That's a key understanding of when the real players are stepping into the market. So when you start to see that, that is an indication we've already done what we need to do. The bigger players are stepping in. We want to ride that wave of where the money's going to flow in. Now, if I go to the 4 hour time frame, when you look at the differences of this piece of price and this piece of price here, this was more likely to turn into a continuation to still trickle higher, versus this is topping out. This is significantly breaking the high and coming back in, which is why we had this run to the downside. Now you might say, well, we still had a run to the downside here. Yes, and we was looking for those trades. How was we looking for these trades? We was not getting caught up into the bullshit losses that you don't need to take. So then what I want to explain to you is this. Imagine you've taken -1 right here, so -1 here, then you're chasing a position, maybe even took a -1 around here as well. But let's say, for argument's sake, you took this as a loss. Then you're looking for trades, right? It goes back up and you're interested in taking trades in here. It sells off, you start looking for trades in here, right? You take another loss because it's sitting on the low. You fail to identify that it's still part of all of this consolidation. It hasn't cleared anything significantly yet. Then what happens? We actually clear the low, and then we get our continuation that retests the back end of the lowest wick. So if I go to the 15 minute, so you can see it a bit more clearer, chuck in our ray line, you can see the low, and then you can see the sections, the 1, the 2, the 3, the scoop back up. You can see this near misses that gap. We come up, we take it out. This is where all the volume is. This is where all the liquidity is going to get taken. And then you're going to see this follow through to the downside. So this is not a coincidence. This is very repeatable, typical behavior of any asset class. But what's important here is not the win. The win, anywhere between 5 to 15% depending on your stop. Forget about the return that this made, right? Because you could have had a super tight stop loss and you might say, well, look, I got in with a 30 pip stop and I got out at 20%. Forget about the home runs, right? It's not about the big return. But what I'm saying is there was a lot of room for selling. Don't get me started on profit targets at 2 to 1 and 3 to 1 when you're positioned right at the highs. That would be idiotic to get out at a 3 to 1. It is more likely to take out 90% of this range. But again, I'm not going to go into that as this part of the video. The point being, imagine you're the trader that's taken -1, -1. Do you think you still have the confidence after all of that to still execute on the trade that has met the criteria, which is a break of this low, retest of this structure with a few other criterias? Do you think you would have the confidence? Do you not understand the psychological issue here, in the sense of it's less about you taking losses? Because you might say, well, I'm comfortable taking 2 losses. Maybe you are, but your confidence is still going to get dampened. And I would rather your confidence be slightly knocked, because look, no one is bulletproof. I would rather you be slightly knocked on good losses. These are not good losses. These are avoidable bad losses. This, tagging you in, tagging you out and being part of that, that's a good loss. Why would that be a good loss? Because it's met the criteria. It's done all of it from a mechanical point of view. The mechanics have been met. So it's significantly done what it needs to do. It's displayed the elements that it needs to display. So if you're tagged in and you're tagged out, you go, right, -1, we move on. Losses are part of the game. That's a good loss. You take it over and over again. Not the BS losses within here that can be avoidable. But the point being, when your charts are blown up like this and you're zoomed in, how could you tell the difference? I wouldn't be able to, Because I would look at the same thing and go, well, what's happening on the 5 minute is the same on the 15, it's the same on the 1 hour. No, it's not. That's a load of rubbish. It would be so naive to think that, if we just go to the weekly here, do you think that the market is exactly the same, that the risk factors are identical here versus down here? Do you think even at this stage, taking trades up here is the exact same risk on whatever time frame as what it is up here? Of course it isn't. So you have to look at positioning, you have to look at other variables, you have to look at the sequence of the market, you have to look at what is left, you have to look at other variables versus being too camped out on a lower time frame. And this is where we saw so many of the losses. So I would look at those trades and think, right, that can be avoided, that can be avoided. Okay, that's a loss. That loss is okay because it's just part of the trading plan. But most people don't know what to look for because they're not technically gifted and they don't go into enough detail in the understanding of price to recognize that's actually part of my plan, that's not. They just have a rough idea and think, yeah, these are really good trades. They're not. Certain trades have value and certain trades don't have value, and they're more likely to carry different elements of risk. The same way it was riskier to take trades in here, it was riskier to take trades in here, it was actually slightly less riskier to take trades up there if you knew what you were doing, and then less riskier here. Why? Because it met certain criterias to balance out that risk. Not every single trade has the same element of risk. So now when I go over to the left, and let's go 4 hour, right? Again, this is just off the cuff. This is me just speaking to you on a one-to-one level as to what I see the problem is, why people fail to get consistency. They don't look at everything in unison. They don't look at it all together. They're too zoomed in, and because they're too zoomed in, they force trades, and because they force trades, they affect their mindset, and it's just like this vicious loop that they keep themselves in. But what I want to explain to you is this. Notice the difference between what I said to you earlier. This almost looks the same. But look at the gaps. Look at the volume being generated here. Look at this high that gets taken out, and then we get follow through on a higher time frame. We're talking 4 hour here. So you now imagine we've got this high in at this stage, and I show you this next candle shape. Right? So we get our follow through. Completely different ball game of price wicking towards something versus taking it out, 4 hour follow through, and then continuation into that low. And another prime example of this is like a little bonus tip if you like. The reason why you probably say, Mark, why are you so obsessed with talking about these 3-to-1s? Because I got that question recently. I said, I don't care what profit target you take. What I care about is you telling me that you focus on 3-to-1s and you're also consistently inconsistent. You also have not made it to a payout. You also have spent £10,000 on funding challenges and you've not made any money, but yet you're battling me saying, yeah, I focus on 2-to-1s because I see a few other people do it. See how ridiculous that is? In the sense of, I can just give you a simple metric, right? Even if you don't trade how I trade, I could just show you that and say, right, whatever logic or reasoning you have to entering at these highs, because there's one thing that we could all agree with most systems, which I would hope anyway, that you're looking for where the volume is. You're looking for where the bigger players are looking to step in. So I could show you a simple range and I could test so many examples of if you were to just let your winners run just for a bit longer, and I'm not talking about all of it, just a tad longer, that might fix your problems. I've just given you some value right here and I don't even need to know how you trade. Go and test it. If you don't, you're just straight up arrogant, right? Because I'm giving you free value that could change the game for you. But that would be an example of, if I'm going to enter here, I'm not getting out here at a 3-to-1. That is just rubbish. I'm going to minimum 90% of that range because I can go back over 10 years, over a decade of data and show that to you that it would be illogical for you to close your profits too early. And that could just be the difference. Maybe you're actually a really great trader. Maybe you get into some really great trades. There's a high chance you are also at the same time really zoomed in, and there's also a high chance that you close your winners early and you're psychologically affected by your avoidable losses. And if we was to go through your journal, I almost guarantee you've got a shit ton of avoidable losses that if you just knew how to not get all of them, because I think that's a bit of a fairy tale, but get rid of a lot of them, that could be the difference of your psychological framework being intact to let your edge play out. I'm not even going to get into the psychological framework of deeper psychology. I'm just talking from a pure technical point of view. There are certain technical things that will affect you from a psychological perspective. There is a limit to that, because you will reach a brick wall in which it doesn't matter how much you know about the markets, you're going to sabotage, you're going to make mistakes for much deeper issues, but we won't get into that. So I just wanted to just off the cuff, raw, there's no real time limit on this episode, and just demonstrate to you how simple it is. If you can zoom out, see it for what it is, look at the key details, not try to force trades happening because maybe you just trade. This is my problem with, if someone told me before, forget the euro dollar example or the pound dollar example, you also have the people that just trade US 30. Why would you just trade US 30? Like, it's another example of, if you only trade one market, one instrument, and you're obsessed with that, you are going to force trades. There is a much higher chance that you will force positions, because if you're trying to make payout or you're relying off this as an income, how could you tell me that there is no possibility that if you've not made money that particular month and you're thinking about, right, I've got some things to pay for, that you're not camping out on these lower time frames and trying to make a trade? How could you tell me there's no possibility of that? Which is why I always recommend, listen, if you're someone who's not that keen on trading 28 pairs, and neither am I, by the way, at least have 3 or 4 markets. So if you trade US 30, maybe you trade euro dollar as well, pound dollar, gold, and maybe one other instrument, maybe a yen pair as well. Throw dollar yen into the mix, or dollar CAD. Like, give yourself something, so when the market is not just ranging or you're trading through a squeeze, you're not just going avoidable loss, avoidable loss, avoidable loss, and then going, yeah, I'm just letting my edge play out, while deep down you're extremely unhappy, your confidence is knocked, and you're now trying to force things, and it can create long-term damage that I want to avoid. So I hope that really helps, gives you a bit of perspective. And if you want to see more videos like this from a technical point of view and truly understand positioning, and you want the proper education, then of course the link is in our bio. We have a step-by-step system with Falcon mechanics that will teach you how to identify these value areas and how to not get avoided in trades that just have really poor positioning, poor sequence, so you're not too zoomed in, taking losses that you just don't need to take.